Hey, what's up, everyone? It's Kirk here at OpsShop, trying to get this thing all set up here for the call. So I want to jump on today, and sorry, I'm fiddling with this for a second, and talk about selling option premium and really trying to figure out what the best deltas are to sell premium. So I think I got it set now, which is good. So this question's come up a lot. I have a link in the top of the show notes, or not the show notes, but the commentary here for the live call to our podcast show number 102, which you guys can check out if you want to, which is like a whole case study on this. But I'll be going through kind of some of these case study stuff today, just kind of touching on the highlights that we talked about in that podcast. So depending on whether you want to watch this or listen to that, it's up to you. But I guess the question that people have all the time is like, what delta is the optimal delta to sell at? So do we sell our options at a delta where we have 70% chance of success, or we have a 90%, right? Because people always say, and I get so many emails from people saying like, Kirk, why sell at 70% chance of success? Why not 90? Like, what's the trade-off? Like, 90 sounds better than 70. So why do you do that, one versus the other? So before I want to do that though, if you're watching this either live or not, or whatever the case is, just let me know, like, what delta do you think is the most optimal for an option selling strategy that you're looking at right now? So just add in the comments really quick or something like that. Just the 30 delta or the 15 or the 10 or whatever, like what works for you. And I just want to see what people say here for a second. So obviously there's a distinction between the 70 delta, or let's say a 70% chance of success and a 90% chance of success, right? And this is how I start this conversation with people when I do coaching, is that with 90% chance of success, you obviously are going to win more often than with 70% chance of success, right? So that's a foregone conclusion. We know that. You're going to win 90% versus 70. Well, in a fair and efficient market, there can be pretty much no arbitrage. I mean, you can't have a free lunch for winning at 90% and collecting the same amount of premium that you collect at 70% chance of success, right? So if you're going to win at 90%, you have to give something up. And what you give up when you win at 90% is you give up the amount of premium that you actually collect and keep, right? So that's where this trade-off becomes, we start to have to think about this to ourselves, is like, what is that optimal level between winning more and collecting maybe like enough premium to actually make the strategy worth it, right? So that's where that discussion kind of comes in. So I see people already chiming in and say 30, 15, 30. You might even said the same thing. It's just if you're talking about one side versus the other. So here's the case study that I want to present to you guys. And again, this is all in the show notes that you can link up to if you guys actually want to see it and listen to it on the podcast. So we ended up doing just looking at the premiums on a call option in SPY. And this was back in September. So these are a little bit outdated, but it's pretty much the same thing now. It's not that big of a difference, right? And so we ended up looking at the premiums on a call option. We had the 40 deltas that were trading for $235 on SPY, okay? So the 40 deltas have about a 60% chance of being out of the money. So you're looking at about a 60% win rate, right? And they're trading for $235. So, okay, baseline scenario, right? Like that's pretty decent premium. But you've got a 60% chance of actually winning, right? So sorry if I like beeped in and out there. My wife was trying to call. So 60% chance of winning, you collect a lot of money. Now we looked at the 30 deltas, and the 30 deltas were trading for $140, right? So now we say, okay, if we sell options just a little bit further out, sell options at the 30 delta, we win 70% of the time, conceivably, and now we collect less money at $140. That's 10% more out of, like 10 extra deltas out of the money, but a 40% drop in the premium that we collect, right? So now the picture is starting to kind of maybe shape up just a little bit, just trying to understand, like how these work, that when you sell options further out, you have this incremental decrease in the amount of premium that you take in, okay? So this will probably be a little bit more evident now with the next, I guess, series. So then we looked at the 20 delta options. So we went, okay, so we said, okay, let's go 20 deltas. So now let's back our deltas out 10 deltas again. So instead of selling the 40 or the 30, let's sell the 20 deltas. Now an 80% chance of success trade, the premium drops by 46% in this case to $75. So original premium was $235. Then the next 10 deltas out was $140. Then the next 10 deltas out was $75. Does that make sense? Okay. So there is this, like, you can now start to see that when you sell option premium, there becomes this inflection point. It's almost like a curved like premium line where as you start going further and further out, the amount of premium that you take in exponentially goes down basically to zero as you go further out. And this makes logical sense because you think about it, the further and further these options are out, the less likelihood they have a chance to get hit. So it's like lottery tickets. They become like so cheap. It's just like, look, if you're going to buy them, like, it's just like dirt cheap. They're not worth anything, right? And they have maybe value, a little bit of value, but the value is tied to their probability of being in the money. They're tied to their probability of actually winning, which is almost nothing, right? Goose egg. So now this is crazy, right? So now the next 10 deltas out in our case study, we looked at the 10 deltas on the SPY, and those were trading for $26, which was a 65% reduction in premium from the 20 deltas. So now it gets even more clear, right? So as you go further and further out, generally, as you're selling options, you start to see the amount of drop in premium for every 10 deltas exponentially increase, right? So your first 10 deltas, you had a 40% drop. Your next 10 deltas, your first 10 deltas, you had a 40% drop. The next 10 deltas, you had a 46% drop. The next 10 deltas, you had a 65% drop. And then really after that, if you go out to like the 5 or so deltas, it was like basically like $5. I mean, it was like a significant reduction in premium. So if I could try to answer the question of where is the best premium to be sold, as a generality, somewhere in the 20 to 15 delta on each end is where I think the best premium is. This is where that curve starts to decay, but it's not actually going like dramatically down, if that makes sense. So you actually see like a premium, if you graph premium on those scales, you start to see at like a 20 or 15 delta on each side, you start to see the curve start to drop off, but it's not like a 10 delta on each side, right? So if you combine that, that's like a 30 delta on both sides. It's like a 15 to 20 on one side. That's generally where we find like a good balance between risk and reward. And so hopefully that really helps out. If it does, let me know in the comments or with the hearts and likes or whatever you guys want. Ultimately though, what we did find is that, like with our back testing and our back testing tool, is that for different time periods, there may be obviously different deltas that work better, right? As a generality, we see that during high implied volatility, you want to come in closer. During low implied volatility, you want to go out further, right? And so during different periods, depending on how far out you are from expiration, you might want to see like what deltas actually work best for that time period. And that's why we kind of built that software to do that. So again, everything's linked up right above me in the video here, in the link that goes back to the website, show number 102, which you can download on our podcast. It's all there so you can listen to it and kind of go back through this and rehash. I think it's an interesting concept, definitely interesting to talk about because I know a lot of people have questions about it. Ultimately, there's no one right decision in the case of like if you want to trade at the 10 delta, like knock your socks off, right? Just realize what you're giving up to do that. I think that when you trade options, it's worth the additional risk to come in just a little bit closer, right? To collect substantially more premium for a lower win rate. You're not going to win at 90%, but winning at 70, 75% is still pretty good, right? And so that's where you want to be. So quick questions here. So for earnings trades, I like to trade that's 20 delta or 12 delta or less. And if you double the premium for that, you get above the strikes. For example, 100 strikes should pay at least 150. Sure. If you want to do that, we actually just started back testing some more of the earnings stuff. So we'll have more details on kind of what works for that. And so we're doing a lot of testing on premiums and deltas and stuff. So I don't know if that's totally what the best thing is you should do. I'm sure it could work for sure. If it works for you, great. Then that's obviously going to be something that we test for sure. Somebody else had a question here. Jason said, under each line behaves differently. Can you remember them all? VXX is different than UCO and different than Nugget or whatever. Find the delta by running a test first. Yep, you got it. I totally agree. That's what we talked about earlier. Definitely run those tests first. Just see what works better in that environment. I mean, 10 days from expiration is different than 60 days. And you should be adjusting your deltas accordingly for that, amount of time that you're, are from expiration or where implied volatility is. It's a dynamic approach now. It has to be dynamic. I always use the real estate analogy that like not every house that you look at is a fix and flip, right? Like some houses are better to renovate and rent out. Some are better to fix and flip. But a lot of people are going into this like every deal or every trade that they look at is the exact same setup, and it's really not. It should be a little bit more dynamic than that, and hopefully we can help out on that. So if you guys have any questions or need anything else, let me know, but we'll jump back in here tomorrow as well. So hopefully you guys have a good start to the week. And by the way, I wanted to talk about this in the beginning, but I figured it was a little bit off topic. I can't believe we still celebrate Columbus Day. I mean, I guess I can believe it, but I don't know. It's not a holiday like I really celebrate. So if you're with me on that, let me know in the comment section. Or if you like totally opposed to it and you like go all out for Columbus Day, you dress up, you go to the New World, like whatever you want to do, just let me know. But I can't honestly believe that we celebrate that holiday anymore. I think it's kind of crazy. So you guys let me know in the comment section. But we'll talk to you guys soon. Take care.